sheet. Obviously, you can insert a new sheet by also going Alt-H, I for insert, and S for sheet, but you do it whichever way you're comfortable with. We're going to double click in here, and we're going to call this the AS sheet. So that's quite a funny name. I like to keep my titles in my tabs quite simple, so the AS sheet is not actually a donkey or anything like that. It's actually the assumptions sheet. So let's go and let's start putting in some assumptions. Now, you don't need to format everything the same way as I do, but we have some shortcuts which we teach in the Excel shortcuts tutorial at Video Financial Modeling. So you don't need to format it, but you can if you'd like, or if you've learnt these shortcuts, then you can. Now we're going to add in some assumptions like we said. I'm just going to change the column width. So if you go Alt-H, O for format, and we're going to go width for column width, and we're going to go 2.5. And now we're going to add in, so we're going to call this assumptions. I'm just going to format mine. I'm also going to change the size to custom. Like I said, you don't have to do that, so don't worry about that. Now we're going to put in some general assumptions. We're going to put in a model start date, and we're going to have that equal to the 31st of December 2012. Well, let's put it 2011. We're going to have an inflation of 2%. And there are our general assumptions. Now we're going to put in the revenue, or let's call this operating assumptions. So we're going to put in title revenue. I'm going to italics and bold that. And then I'm going to put in a car toll, truck toll, number of cars per day. And obviously this will be at a model start date. So I'm going to put in a note at model start date. We're going to put in the number of trucks. We're going to put in the number of cars growth rate. And this is a per annum percentage figure. And we're going to put in the number of trucks growth rate. Okay, I'll talk a bit about each of these. So if you're struggling to catch up, take this time to catch up and enter in those labels. So obviously the car toll is just the price per car. So if you're going through a toll booth, it could be $4 that you have to pay to go through that toll booth, etc., etc. It's just the price per car. Same with the truck toll. The number of cars per day. So we're looking at this on a daily basis at the moment, and we're saying that, okay, how many cars are passing through that toll per day? And obviously the revenue that you get from that would be the number of cars per day multiplied by the car toll. Now, obviously over time, the number of cars that are going through that toll is probably, or more than likely, going to grow. Your economy is growing, the people living in your economy is growing, and more people are going to be using that road. So this is what this assumption is, and the same with the truck growth rate. So let's put in those assumptions now. We've got $3.25, $5.25, 80, 1, 2, 3,000, 9,000, 4%, and 2%. Okay, I'm just going to format these quickly. Like I said, I'm sorry about that. Don't worry if you aren't formatting them. That's an aside, that doesn't really matter. Now what we're going to do as well is we're going to put in some, so let's just chuck a couple of rows up here. So you can select the row, right click, and then insert the row if you'd like. And we're going to include, a data type in column D. We're going to include data units, and we're going to include a name. Okay, so I'm just going to bold those, and let's just change the columns widths, but we'll change that back anyway. So the reason I'm coloring these assumptions in blue is because these are inputs. These are hard-coded numbers and they're inputs. They're not calculations or anything like that, so that's why we're going to put in input here. And I'm just going to copy that down, so Control C, Control V. Okay, the data type, so this one's a date. This is a percentage. We've got a few more percentages. Like I said, you don't need to put in these data units. I'm just doing this for completeness. If you're struggling for time, don't put in the data units. Focus on putting in the names that we'll come to in a second and naming the cells. So let's go dollar per car. And we're going to change this one to dollar per truck. And we're going to put numbers. So these are numbers. And now this one's the important one. So now we're going to put in names. So I'm going to call this start date. Very original. So I'm also going to go Alt H O and also change the column width. So I'm going to auto fit the column width. So I'm going to go I. I'm also going to put in inflation. So inf. I'm going to include a car toll. And what we're doing right now will become apparent shortly. So bear with me and type these out. Car toll, truck toll, number of cars per day, number of trucks per day, car growth rate, truck growth rate. And I'm going to go Alt H O and then I again for column widths. Now, there are two ways of naming a cell. The first involves naming an individual cell, and the second involves naming a group of cells. Let's name the car toll first. So let's go to that cell, G11, or whatever cell it is on your spreadsheet at the moment, the car toll. Go Control F3, and then go Alt N, or you can simply click the new there. So Alt N, push Enter, and then push Escape. Now what you'll see, if we go back to that cell, in the top left-hand corner, you'll see that the cell's now named car toll. Okay, another way to do it is let's go up here. Let's highlight these 4 cells, and let's go Alt, and we're going to go M for formulas, and we're going to go Create from Selection, so C for Create from Selection. And we're going to untick this top row, and we're going to say in the left column. So now look at this. Okay, so what's happened is we've named both the inf and the start date together. So now what we can do is we can do exactly the same process with this one. We can go and select the truck toll down to the truck growth rate and go Create from Selection. And the top row's unticked now, so that's good, and left column. Now what you'll see is all those names are, all those titles are named, or all those assumptions are named. Okay, so now we're going to put in expenses. You might be able to see that there's a pattern occurring here. So what we've got is we've got some general assumptions. Now, if we had some construction assumptions, then we would have put those probably in between the general assumptions and the operating assumptions. And then we've got some operating assumptions. So you can sort of see the logical progression. If you look back at the ebook, the key ingredients are assumptions, which we're working on right now. But then also we need to capture the construction, if there is a construction phase, and also the operations, if there's an operating phase. And the next one after this, I'll tell you, is the financing. So you can see that there's a natural progression here. Now, I'm just going to tidy this up. I'm going to format it a tiny bit. And now what I'm going to do is I'm going to put in the expenses. So let's go annual maintenance expense or cost, annual management costs, annual capex, and tax rate. Now, usually the capex would be in obviously a capital expenditure rather than an expense running through your income statement. We're going to treat this as an expense running through your income statement and also your cash flow statement. So usually what would happen is that capex would probably be capitalized and then recognized in your income statement through depreciation over time. But what we're going to do is we're going to directly expense it here. In any case, we're not going to look at the income statement here or the profit and loss statement here. So let's go and let's put these inputs. I'm going to cheat and put in my things there. So also we've got let's put in a dollars, thousands. And let's go and put that there. And now let's go and maintenance and management. So let's spell it that way. And capex and tax rate. Okay, so let's put those in. So we've got 30 million per annum in maintenance. We've got 5 million per annum in management costs, and we've got 2.5 million worth of capex. Okay, and we're going to use a 30% tax rate here. Okay, so I think we do actually use our income statement here, but we're going to treat this annual capex as an expense for the purpose of that income statement. So let's go and let's keep going. Let's put in our debt amount. So of the acquisition, we're going to find out a price for this toll road, and of that, we're going to have a proportion of debt that we're going to use to buy it out, and also a proportion of equity. So we're going to put in a debt amount, interest rate, term of debt, years, equity, discount rate, and we're going to put in a target debt service coverage ratio. Okay, so now these are all inputs, and we've got a debt amount, interest, debt term is years. It could be a number. Let's put a number. Equity discount rate is a percentage, and target debt service coverage ratio is a ratio. Okay, so let's put in total debt. We don't know the total debt now, so don't worry if you think that we don't have that as an assumption. We're going to highlight it so that we know to come back to it. So we've got total debt, int rate, debt term, equity, rate, and target debt service coverage ratio. Okay, so let's put in those, the ones that we do know. 7.5%. I'm going to color that blue. We've got a 10-year debt term. I'm going to color that one blue as well. We've got 13%. And we've got 1.25. Color that one blue as well. So let's name all these cells. So let's go Alt, and we go M for formulas, C for create from selection, and name those. And we'll do exactly the same with this. So Alt, M for formulas, C for create from selection, enter. So all those should be named now. If you haven't done that, just stop the video, take your time and name those cells. Okay, so now what we're going to do is we're going to get onto the nitty-gritty of the model. So this is where we actually bake the cake. So let's put in another sheet and let's call it calculations. I'm just going to call this one calculations. And I'm going to change the width. Well, let's go, and with 2.5, I'm going to change the view. Don't worry about it. You can leave it in the current view. And I'm going to change that. I'm going to do that same to that one as well. Okay, so let's talk about the calculations now. So let's go and let's firstly put in a year ending. Another critical assumption is that we're only going to take this up to 2021. So there's going to be a term of 10 years. So we can put that term in, term or end date. And we can just say this is going to be EO month, bracket, select that date, start date, and then go 12 times 10. Now, this is probably not best practice modeling, but we only need to know that that's the end date. And we'll leave that as an input because we've put some hard-coded numbers in there. Okay, so let's go back to the next one. So I'm using Control Page Down to navigate, but you can simply click on the tab. Now we're going to have a year ending and we're going to have a year counter. Okay, and in cell D, we're going to have, this is going to be a date, and this is going to be a number, right? In cell G, we're going to have equals. Now, what we can start doing is we can start typing our start date. Yeah, so we'll type in our start date. It comes up here, and that's our start date. Now, if it comes out in that format, then if you've done our Excel shortcuts tutorial, you can simply push Control-Shift-D. If not, right-click, go into the formats, and change your number to a date. Yeah. Okay, I'm going to say that that's a red formula because that's going to be a unique formula across this row. And we're going to type in EO month, that, comma, 12. Strictly speaking, that's probably not the best modeling because we've got a 12 in there. We can always put a 12 for the months in the year on the assumptions page. So then if we obviously change our periodicity or something like that, then we could have it fully flexible so it changes here. Once again, change the format of that. Now we're going to go all the way out to December 2021. Now, what I'm going to do here as well, I'm going to go Control spacebar or just select this row, Control Shift arrow across, and I'm going to hide these columns. Just make it easier, a bit cleaner.
And we're going to name this row. So this is a fancy sort of thing. So what we're going to do is we're going to go fin year here. I'm going to make that red. Now, shift spacebar, or as long as you're pointing to this fin year, you can probably go and select that as well. And we're going to go Control F3, Alt N for new. No, well, you can't do it that way. So let's go Shift spacebar, Control F3, Alt N for new, and let's go OK. So the Shift spacebar selects the row, but you've got to be on that cell and push Shift spacebar, Control F3, Alt N, and then Enter. Okay, so that one's named, so you'll see that in the top left-hand corner. Now we're going to put in a 0 there. Once again, that's a unique formula. It's a hard-coded number as well, so we're going to put it in red, and we're going to go year counter, and we're going to go equals that plus 1, and then we should have 10 years. Yeah, we've got 10 years. Again, what we're going to do is we're going to go to this cell, Shift spacebar, Control F3, Alt N for new, and Enter. Okay, so there we've got some calculations in. We're going to leave this section now. We're going to call this cash flow summary. And we'll come back to this later. So you can color it in yellow so you know that you've got to come back to it later. We're going to put in some indicators that we're going to use throughout the model. So the first one we're going to do is we're going to put in an inflation index. Then we're going to put in a cars index, a trucks index, days in year, and then we're going to put in okay, so we're going to start off, and we're going to start off with these being 100%. So these are red figures, or they could be blue as well. Now, we've talked about our inflation before. If you skip back to this page, remember our inflation right here. We're going to put in an inflation index. Now, this is a pretty simple formula because it's just a yearly model. All we're going to do is go equals that times 1 plus inflation. I'll just get that out of the way. And let's copy that one all the way across. So you'll notice that it firstly goes up by 2%, and then obviously it goes up by a bit more than 2% because we're compounding, and so on and so forth. So what we can do is I'm going to cheat. I'm going to show you a quick way to cheat. I'm going to go Shift arrow down a couple of times and Control D. So this is the car growth index, and it's not going to be the inflation, but it's going to be the car growth rate. So what I just did there is I highlighted that inf, pushed F5, and then a go-to box comes up, and then I pushed enter. And then I went to the inf, but now we want to change this to the car growth rate. So we've done the first one, so now let's select that inf again, press F5, enter, and let's go select the truck growth rate. Okay, so let's copy those across. So you can copy and paste. It's pretty easy like that. Or what you can do is you can go Shift arrow down, Control Shift across, and Control R. Now we buy this asset on the 31st of December 2011. So the first full year is going to be there 31st of December 2012 back to the 31st of December 2011. So H3 minus G3 will give us the number of days in that year, and that's pretty funny. The 2012 year contains a leap year. And now we've got a number of indicators. So we're going to put in this one, we're going to put in inf and then index. We're going to put in car index, truck index, and days in year. I'm going to color those red, and we're going to do exactly the same thing. So we're going to name those rows. So let's go Control, go to the inf index, Shift spacebar, Control F3, Alt N, Enter. Go to the car index, do the same. So Shift spacebar, Control F3, Alt N, Enter. Go to the truck index, Control F3, Alt N, Enter. Shift spacebar, Control F3, Alt N, Enter. So we've named all those now. Okay, so now we're going to get onto the operations or calculations related to this project. So let's go. Okay, and the first thing we're going to do is operations. We're going to go car revenue. I'm going to color this in a bit, make it a bit prettier. And I'm going to start labeling some other things as well. So I'm going to put this one as truck revenue. I think the next one is, so there are the revenues, annual. So we can, I'm just going to cheat. Put a few rows in there. Put a few rows in there. I'm going to format paint these. So let's go home. Alt. No, let's not do that. Let's. Okay, so don't worry about that. Just make sure you've got the labels there, and we'll go through each in turn. So now we're going to put in the number of cars per day. So let's just build this up logically. How many cars are coming through per day? How much does it cost per car? So toll per car in dollars. And then we get our, if we multiply those two together, we get our daily revenue from cars. Now we're looking at a yearly model. So before we do that, let's just freeze some panes. So let's go Alt W. So go up to F5 and go Alt W, and then F freeze panes and F freeze panes. This just makes sure that our first few lines are always in view, so we can always see our dates. Sorry about that. Okay, so let's get back to these calculations. So let's go find the number of cars per day. Now remember, we've got this car growth index. Let's put it car growth index and truck growth index instead of just index. So if we grab the number of cars from the assumptions page, which is 80,000, multiply that by the car index. That'll give us the number of cars per day. And now we only want to start this one from December 2012 because that's our first full year of operations. So let's copy that across. So Control R to copy that across. So the next one we're looking at is our toll per car. In this tutorial, we assume that our toll per car is increasing with inflation. So we're going to do a similar thing to what we just did with the number of cars per day. I'm going to grab the car toll and we're going to multiply it by the inflation index. Okay, let's copy that one across. Just going to do one less decimal here. Oops, one less. And then we're going to multiply the two together. So that multiplied by that. And now we're going to put in some units here. So we know this is number, this is dollars, and now we're going to put in thousands of dollars here. So let's put in thousands of dollars. And if we obviously do that, we're going to have to divide this number by 1,000. Okay, so that's our daily revenue from cars. Now we know that this is a yearly model, so we need to convert it into a yearly figure. So we've got our days in year, and that's going to be a number. And if we multiply the daily revenue from cars times the days in that particular year, then we're going to get the annual car revenue. So let's go annual car revenue. And let's just copy that one down. Let's go and grab, so let's go equals, and this is just the indicator we had before, or the counter we had before, and Control R to copy that across. Or obviously you can, if you're not at that stage, you can drag that one across. Okay, so let's now multiply the two together to get our annual revenue. Okay. Now I'm going to cheat on the truck revenue because it's very similar to the car revenue. So what I'm going to do, and you can do this as well, let's just copy these rows. So copy, so select the rows, hold down your mouse left click and Control C to copy. I'm going to paste them here. So Control V to paste. I'm going to change these titles obviously to truck, truck, truck. Now, if you do this, you've got to be very careful that you get all the cars out. So let's, because they're exactly the same formula bar the trucks, let's just change everything here. Trucks, trucks, or truck index. And now we're still going to inflate the toll per truck by the inflation index. So that's a generic assumption. And those should all be the same. So let's see if that works out. Yeah, that looks right. Okay, so now we're going to go down to our annual maintenance, and or let's call this operating expenses instead, and let's delete this one. Okay, and let's go maintenance costs and then management costs. So remember, on our assumptions page we had three expenses. We had one to do with annual maintenance, one to do with annual management, and one to do with annual capex. So let's do this. So let's go total operating costs, and let's go equals. Now this is the annual maintenance costs. So let's go that. And let's multiply it by the inflation index. So here we're assuming that the annual expense is going to go up with the inflation index. And let's put a negative at the front as well. So just chuck a negative in there. I'm going to copy that one all the way across. So shift, hold your shift key down and arrow across, and then Control R. Now we're going to do a similar thing with the management costs. So I'm just going to copy this down. I'm going to do exactly the same thing as we've done before. I'm going to highlight that annual maintenance. I'm going to go and change it to the annual management using my arrow keys. Okay, and shift. or Control Shift arrow across and Shift arrow left and Control R. Okay, so the sum of those two is going to give us our operating costs. I'm just going to copy these down. You don't have to. And then now we're going to go on to our annual CapEx, or our let's call it capital expenses instead. Okay, so now we have our capital expenses. Pretty easy to calculate. All we're going to do, it's going to be thousands of dollars again. Going to go equals, so similar formula to that. So CapEx multiplied by our inflation index up here. So just going to grab that. You can obviously type this one in, inf index if you'd like. And then I'm going to make that a negative number again. And I'm going to copy that one across. So Control R to copy across. Okay, now what we're going to do now is we're going to do a simple tax calculation. So this would be under operations, so we may as well put in operations here. So tax. Now this is going to be a pretty simple calculation. All we're going to do is we're going to put in annual revenue, or let's go just revenue, total revenue. Total operating costs, capital expenses, interest expense, and then we've got our assessable income. So you can see what's happening here is all we're doing is basically building up a little income statement. Now, very basic income statement, but we're still building up an income statement. Now, we're going to highlight these for the moment. We're going to come back to it. So we're going to highlight them and come back to it a bit later. Now we're going to concentrate on we know we've got to fill these in, by the way, but we're going to concentrate on the financing for now, because some of the financing comes into this assessable income. So let's go and I'm just going to copy this one down. I'm going to paste that one. I'm going to put in financing. Yeah. And what I'm going to do is, we know that we've got a debt account and the remainder of our acquisition cost is going to come from equity. We know that we've got a hurdle equity rate of 13%. So what we're going to do is we're going to put in a debt facility. So let's put in opening balance, principal repayment. I'm going to highlight this principal repayment because we're going to come back to it. And I'm going to put in a closing balance. So for those of you who have taken any of video financial modeling tutorials, you'll recognize this. It's a type of corkscrew account. Those of you who haven't, it doesn't matter. All you've got to know is the principles behind once we go through this. So what we're going to do is, at the start, we know that we're going to have a number, a amount of debt that we're going to draw down for the acquisition of this toll road. So I'm going to highlight that one in grey. I know we've got to fill it in. I know it comes in on the 31st of December and we have to pay it down during the next 10 years. So the opening balance on the 1st of January 2012 is going to be the closing balance on the 31st of December 2011. So if we make those two equal, that should be all right. The closing balance of the facility is simply going to be the opening balance minus any principal repayments in this instance. Now, there's no accrued interest or capitalized interest in this case, so there's no problem there. So let's go Alt equals, to sum up, and then let's select those, drag them out, or control right. Okay, so we've got nothing in there at the moment. We've simply set it up so that once we've got a number here, and that number is going to be actually, we can put that in equal to this one here, back at our assumptions, our total debt. So enter. So as soon as we put a number in here, 500, then look what happens. Then we've got 500 coming through our account. Okay, so I'm just going to delete that one for the moment. I'm going to put it to 0. And that's going to be red as well. Okay, so we've also got, I'm just going to tidy this up a tiny bit. Okay, we've also got the interest expense, the debt service. Okay, so the debt service will simply be the interest expense plus the principal payment. So let's just copy and paste these ones. And we've also now, I'll talk a bit about this one in a second, but let's just type it out for the moment. We've got a credit foncier repayment profile. Okay, and that is going to be the same thing as that. Okay, so now we know our interest expense. We know that our yearly interest rate is 7.5%. I'm going to keep this very simple. I know that the first year is a leap year, so there's going to be one extra day of interest, but we're going to keep it simple. So all we're going to do, multiply the opening balance times the interest rate. So go grab the interest rate, use your mouse if you'd like, select that, and let's push enter. I'm going to make that a negative number as well, and we can go like that across. Okay. Okay, so let's look at this credit foncier repayment profile. Now this is the principal repayment that you see in this corkscrew account. So let's go and call it principal repayment as well. Now let's go equals PPMT, open bracket. We're going to go up to the function, insert function. So now the rate, we know the rate. So the rate is the interest rate per period. For example, 6% divided by 4 for quarterly payments. Now we've got yearly payments, so we can go directly to the assumptions page and put in our interest rate. Okay, so the per specifies the period and must be in the range of 1 to n per. Now n per is just going to be the term of our debt. So let's go and grab the counter. The next one we're going to look at, so let's go, that's all done, is the n per. Like we said, the n per is the term of our debt. So let's go and grab the term of our debt. And the present value is going to be the debt amount. So let's go grab the total debt amount, which is set to 0 at the moment. And let's go OK. Now let's change this. So let's change it to 500,000. Okay. And let's see what happens. So now what we're going to get is we're going to get a repayment profile. Now you would have to do other things to this formula if the debt term didn't coincide with the end of the project. We're going to leave it simple for now. And I'm going to talk you through exactly what the credit foncier repayment profile is. Now, it's a fancy name. It's quite a simple concept. So let's firstly put in the principal repayment, enter, and I hope that this comes out to 0. Yes, it does. At the very end, it comes out to 0. So that line's done. That one's done. And that's all fine. Now our debt service is going to be our interest expense plus our principal repayment. So we can go equals that plus that. Okay, and let's copy that one across. So drag it out and it's all good. Now, what do you notice about this line? Okay, obviously this line stays constant throughout the life of the project. So the amount of debt we're paying back to the bank, whether it be in the form of interest or pay downs of principal, is constant. So this looks very familiar, and it's basically like a home mortgage repayment where you pay a fixed amount per year or per month. Okay, so let's go on and let's start putting in some stuff up the very top. So let's go and let's put in annual total revenue. So now we're building up our cash flow statement. So like we said, this is like the fifth ingredient. This is one of the important ingredients that goes into a project finance model. Let's go total operating costs, capital expenses, and then we've got this new thing that's tax payable now. And now we have this concept that says cash flow available for debt service. Now, the video financial modeling team is going to be talking about this cash flow available for debt service in some blog tutorials. So don't worry if you don't get it here. You can always catch up on the blog tutorials. But basically what it is it's your, as it suggests, it's your cash flow available for debt service. So it's usually your revenue minus your expenses, minus your tax, and then some adjustments for working capital as well. But this is the amount that's available for the financiers, firstly for debt or senior instruments, and then secondly for equity or shareholder loans or something like that. So that's the cash flow available for debt service. So we have an interest expense related to that debt service, and we have a principal repayment. Okay, and we have a cash flow now, as you may have guessed, available for equity. Well, let's assume that we can distribute everything, and let's go cash flow distributed to equity. Okay. And let's go and grab the total revenue lines. So let's go equals car revenue. So that plus that will give us the total revenue line. Our operating expenses, we can go and grab. There we go. Our capital expenses, we can go and grab. Now our tax, we can't at the moment. We're going to put that in a second. Let's copy these ones across for the moment. So use your mouse if you'd like. And let's sum those up. Okay. So we know we still have to do tax, but we've summed up the cash flow available for debt service. And we're going to call this CFADS, and we're going to name it. So let's go Shift Spacebar and Control F3, Alt N, Enter. And that should be named now. Yes, it is. Let's grab this interest expense for the debt. So let's go interest expense, and let's go and find the principal repayment. Okay, now we're going to go equals sum, open bracket, comma. So select that CFADS, comma, and those ones. So select those two as well. Okay, so that's our cash flow distributed to equity, and then we can copy those across and push enter. So now we know that our debt value, the very start, let's start just formatting this ever so slightly. Okay. And we know that our debt value, we know it's simply going to be equal to, and the debt amount. Now, we're not saying that 500,000 or the 500 million rather is the debt amount. We're just putting a placeholder for the moment. We can go enter. And we know that the equity value is going to be, so equals X MPV bracket. We know our hurdle rate, so we can go and grab our equity rate, comma, and then we can grab our values. Now we want it valued from the 31st of December 2011, so we're going to grab these ones. I'm going to take out that calculations there, and then we know the dates are there as well. So once again, you can take out the calculation and then put enter. Now we're going to have to put a 0 here, and we'll just put it in red. Now you can copy these formulas all the way across if you'd like. Either or, that's fine. So now we've got an equity value. So now we've got a total acquisition value. Now some of you right now might be saying, whoa, you're going way too fast. I'm not getting all of this. That's fine. We're going to talk quickly about this equity value here. So all we're saying at the moment is we're saying, okay, we're going to come in, we're going to buy this asset. We're going to put some debt in. We don't know what that debt amount is yet, so we've put a plug figure in. We're going to put some equity in also, and on that equity, we want a return of 13%. So if we put in equity of 176 million or 176.5 million, we're going to get that 13% return. That's all that equity value is saying. Okay? But before that, obviously we need to fill in the tax. So let's go grab our revenues. Now, when I'm filling in things related to tax or something like that, or referring to a total revenue where I've got a total revenue up in the cash flow summary or a summary of a particular sheet, I like to go and refer to it up the very top. So let's do that. I think all of those are the same except for this one. So I've just copied those ones down, and I'm just going to grab the interest expense as well. So let's go Alt equals, and let's copy those ones across. And all I'm going to do now is tax payable. So I've just entered some more lines in, just so select it, and so insert rows, and we're going to get the tax payable. Now, remember we said that it was tax rate is 30%. So if we multiply that tax rate by this one, once again, that calculations pops up. I just delete that. That's going to be our tax, yeah? Very simple sort of analysis there. I'm going to change that out, and I am going to link that back up the top. Okay, so tax payable. Copy that one across. So shift arrow right a few times and control R, and then there is our cash flow summary. Okay, it's not complete, right? We're still saying we don't know what this debt value is, right? So let's go back to our assumptions page, and then let's see how we target a particular minimum debt service coverage ratio. So what we're going to do is we're going to put in a actual, so this is our target, sorry, that should have been minimum debt service. This is our actual minimum debt service coverage ratio. Right, so actual, but this is going to be a calc rather. And Control F3, Control N, and enter. So where we're going to get this from? Well, we've got to build it into our model. So if we go down to the financing section, we're going to put in a thing called ratios. Now, the debt service coverage ratio basically equals your cash flow available for debt service divided by your debt service. Now, there can be broader definitions of that, but that's the basics of it. So what it's saying is how much cash do you have and how much is related to debt service. The higher the debt service coverage ratio is, the better the project is, or the more coverage before you start being in financial distress. So let's have a look at that. So let's go cash flow. Now let's not do that. Let's just go CFADs. We've already named it, so CFADs. And we'll copy that across. And our debt service is, now we can take it from here. Let's just take it from here. Rightio. And so what we said is our cash flow available for debt service divided by our debt service is going to give us our debt service coverage ratio, or DSCR. So this is going to be a ratio. So let's go and see what happens. Isn't that interesting? At the very start of the project, we don't have enough cash flow to pay for our debt service. Okay, so what that's telling me is there's too much debt in this structure. So let's go and let's put a minimum value here. So equals min. We're going to select these cash flows here, or sorry, these ratios here. And so our minimum occurs at the start of the project and it's 0.93. So if it's less than 1, that means we can't meet our debt obligations. So we probably would be in default, or we most definitely would be in default. So let's go and go equals, go back to the calculations, grab that minimum debt service coverage ratio, and then let's try and adjust this. So let's see what happens when we put this down to 400,000. Okay, so the debt service coverage ratio is coming up. Now, what we can do is we can go, let's do a really quick one. And we can go, so Alt, and I believe in the new Excel, it's the what if analysis for the goals. So you can always use, if you're used to shortcuts from obviously 2003, then you can always use those shortcuts. So let's just push goal seek here. We want to set that one to 0 by changing this cell here. Okay, let's push enter. That's pretty close to 0. So now our actual debt service coverage ratio equals our target debt service coverage ratio. Okay, so let's go back, or no, let's firstly put in a check. So let's put in some checks. Now, usually you'd have a check page, but we're going to put our checks on the assumptions page here. We're going to have a debt service coverage ratio check. So all this is saying is equals that minus that. So we can go if that minus that equals 0, comma, okay, otherwise check. Now it's not going to equal exactly 0, so we're going to have to round it slightly. We'll round it to 1 decimal place. So we just do a round function there. That should be okay now. So that's fine. And there's one of our checks. Now we can do some conditional formatting on it. So conditional formatting in your home menu. And we can go a new rule. And cell value is equal to, and then OK. And we're going to set that format to fill green. That's a bad green. Let's go with that green. OK. OK. So that'll format now. I'm going to add another rule. And we're going to say, well, we can go manage rules rather. Edit rule, or let's go new rule and format only cells that contain equal to, and then when it goes to check, we want it to come out in a nice red color. So stop, something's gone wrong, and apply. Okay, so let's see what happens if we change this. I'm going to change it straight back. Okay, it goes to red. So 1.25, let's Control Z that. Okay, and that's that. Okay, that pretty much concludes our tutorial. So let's just sum up the basics that we've looked at in this tutorial, or this brownfield acquisition of a toll road. So you need 5 things in a financial model. The first one is obviously the assumptions, which are critical to the outcome of the model. The second one is the construction costs if you're looking at a greenfield or a startup project. The third one is the operations, so we're looking at the revenue, the expenses, and the taxes. The fourth one is the financing, and the fifth one is obviously the cash flows. So what we found from this model is that we could purchase the asset at 504.6 million, of which 354 million would be debt and 151 million approximately would be equity. So we're talking about a debt to equity ratio of 70 to 30, which is typical with infrastructure projects. Sometimes it can go obviously a lot higher, and it depends on the credit worthiness of the guarantor in most cases, or if it's not guaranteed, the credit worthiness of the revenue stream that's coming through. Now, I think I've overbaked this cake. I think I've taken too much time on it. I think we're up to the 70-minute mark, but hopefully you can take some key points away from this